Well, welcome to December, the final month of the year, obviously, and the business end of proceedings. And for some people, it's a chance to max out that profit and loss before we start getting into a very, very expensive period at that time of year. We are seeing volumes starting to dissipate and pull back, but markets are on the move. We're seeing movers and shakers on the dance floor at the moment. We break those down. We point you in the direction of where the trades that we screen very compelling at the moment. So let's go. This is the trade-off. Hi, I'm Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds, as always, by Blake Morrow from Forex Analytics, and we will be discussing all the trades that we like, the movers and shakers, where the skew and directional risk looks to be sitting, and focusing on some of the news that's breaking in this moment as we go into what could be a very lively December for markets. There's certainly a lot of event risk coming through. So, Blake, come into the programme, my good sir. Snappy haircut there, mate. You're looking very sharp indeed. Obviously, preparing yourself for a blistering cold winter out there.
Blistering cold, so cold. It's like maybe 25 degrees. I don't know.
Beautiful, mate. Is that why you put your jacket on? But yeah, I did see.
That's the only time I can put my jacket on.
Well, we're going to be focused on natural gas, which has been moving up because of cold weather climates in certain parts of the US. Obviously, not hitting your part of the world at the moment. But yeah, it's interesting. You know, we'll go into some of the thematics in a second. But yeah, people I'm talking to now, it does start to feel, doesn't it, that people are just winding it down a little bit, closing out some of those positions. I know we saw cash equity volumes about 10% below the 30-day average. You know, S&P options was certainly lighter than what we've seen, and you know, we saw that futures as well. It does feel that people are just starting to wind it down a little bit. Is that what you're hearing from people?
Yeah, it's funny. Our team's been talking a little bit about end of year flows, and you know, and even though it feels a little early, it really isn't. I mean, we've got maybe another 2-3 weeks of good trading, or maybe two weeks of good trading left before volumes really just dissipate between Christmas and New Year. And if you're trying to make your year in that week, it's going to be very difficult. So I believe that everybody's just trying to wind down just a little bit, but there's still a lot of risk beyond the horizon, just the immediate horizon, which I know we're going to be talking about here in just a few minutes. Well,
Mrs. Weston has been very, very busy getting presents coming in. They've been sort of knocking at the door every 2 seconds, DHL. So yeah, I think I'll be working right to the last minute, try and max out that P&L effect as well. But anyway, let's go into the thematics that you know certainly makes sense at the moment and getting talked about. Let's go into Topical Thunder. Let's take a pulse of the markets. Cracked on in the first week of December, going into talk about some of the event risks that I've got on the radar and you've got on the radar throughout this month. But you know, the equity markets in the US, they look like they're rolling over, bang, and then it's just by the dip. Everyone goes. We've got the Russell, the small cap index. For me, looks probably the strongest of the four major indices at the moment. I know we've got the Nasdaq and S&P flirting with all-time highs as well. But yeah, we're seeing seeing the volatility. You know, you are seeing the Russell making a stance. I mean, going to European equity markets, the IBEX in Spain's up for 8 straight days, and it's pushing the recent highs. That market looks really strong as well. We've got the dollar rolling over. Volatility's come back. The VIX is trading just above 15%. We kind of talk about this seasonal rally. I'm not going to use the word, but yeah, the seasonal rally in play. And then things go down, risk, and then it's back up again. How are you sensing? What are the trades that you like at the moment on a cross-asset basis?
Yeah, you know, Chris, it's I think there's a lot of it that's all happening all at once. And I think a lot of it leads back to the FOMC, which we're going to talk about here in a moment. But also, you know, the when President Trump slipped the Fed governor, the new Fed chair, Kevin Hassett, on accident in a press conference, as he introduced him as the next FOMC president, or FOMC chair,
Yeah.
The market actually took that as a big cue, and it's so interesting because I think that's one thing that the market just was kind of worried about, like who's going to be who's. It's one thing they don't have to worry about, and you got seasonal factors. Yeah, you have the dollar under pressure, probably a little bit for what I was just talking about with Kevin Hassett, as the it looks like he's the shoe-in now for the Fed chair. But there's more to it than that. There's the FOMC as well. But then you just have end of year flows, and we're nearing. I mean, for the year, if we get to 7,000, we're going to be up like 18% on the year. That's a good year just in the S&P, and I'm not talking about other markets. Like as you're pointing out with the IBEX, even France has rallied this year. I mean, we've seen some pretty strong asset moves, and the dollar. Let's just call a spade a spade. It stayed weak. It's weakened at the beginning of this year, and then it's really just kind of consolidated on its lows for the last, since June. So I think there's a lot of things that are pushing us to the idea that you can't really fade this market right now. I don't think it's a fadeable market into year end unless something jumps out at us.
Yeah. Well, I'd been thinking myself that we're going to see a breakout in the US dollar. We had the dollar index chart up a couple of times, and it just failed to get above the range highs, and it's rejected that level. So, that for me was a pretty telling situation. I don't know about Kevin Hassett's now 74%. It's come back a little bit on some of the betting exchanges, but I think what Trump said, you got to think, was that just a genuine error that he's released the cat out of the bag, or was that designed to just throw some to catch markets off guard? I don't know. We'll have to see. But I think the interesting thing about Kevin Hassett while here is that he is just one man. He is just one vote effectively within a 12 voting committee. So how much can if the data's not there to support his political agenda potentially, the rest of the voting committee are not going to go along for the ride. So there are checks and balances there. But bond traders apparently, according to the FT, have been coming out and saying that they are quite worried about a Hassett appointment because of it represents the closest thing to a loss of independence from the Fed. Obviously wants rate cuts, but also the other thing about Kevin Hassett is that he wants to continue shrinking the Fed's balance sheet. And I'm not sure that's necessarily a great idea given where reserves are at the moment. So it's an interesting, we'll have to see how the market sort of takes that one going forward.
Yeah, and I know we need to move along to the FOMC, Chris, but I do want to just mention with Kevin Hassett, remember, you're right, Trump might have just slipped that accidentally or on purpose. Regardless, he is getting an earful from Wall Street, as you pointed out in the FT. The fact of the matter is he said he's not even going to make an announcement until after the new year. Right, so he's just going to ride. He's just going to ride this as long as he can. Even if Kevin Hassett isn't the man, I think he's going to wait until after the beginning of the year and let the stock market go out on the highs.
Mate, that makes sense. But Trump's not the sort of person who hangs around. I think if he's got something to say, he'll probably say it, right?
That's another good point. All right, well, let's talk about the Fed, because the FOMC actually happens next week, and it happens next week before we do this trade-off again next week, which I believe we're doing. I know we're heading into the holidays, so it gets a little tricky for scheduling, but regardless, we're not going to see until after the Fed. So I did want to speak a little bit about it, because we got ADP non-farm payrolls today. They were, worse than expected. We had ISM services number. Everybody's kind of focused on that. Came in line. We had ISM services earlier in the week, and we're starting to. We've almost got all the data that the market needs to see to realize that the Fed is going to keep rates unchanged. Now, the interesting thing is, Chris, I think a lot of traders and a lot of people are expecting the Fed to actually give us not only a cut, but a hawkish cut. So kind of like what we saw the RBNZ this week, where they cut rates, and it's kind of like, okay, now we're going to wait for this incoming data, from here on out. But I don't know if the Fed is actually going to. I don't know if Powell's going to leave it as hawkish. I think he might leave it very open-ended, which might give the market some ideas that they could continue to cut into the beginning of the year if needed, especially if the data continues to worsen. And if that's the case, then we might actually get a continued rally in assets, because I think the market is poised for a hawkish cut right now. But if we get a neutral cut,
and
we get a cut.
I was just about to say that. Like, yeah, I think you're right.
I know it sounds silly, but you know what I'm saying, Chris, is when the market has all these expectations that the Fed's, going to pause, and we're going to be pausing until, the Fed chair is gone. And then, Kevin Hassett comes in, or whoever, Waller, or, whoever it is that comes in, doesn't matter. If they believe that there might be another cut at the beginning of 2026, could we get a continued rally? What are your thoughts on the Fed as we go into next week?
I like the neutral cut. I think that's absolutely, you've got to be, that's where you're going to be. So, the cut, the market's pricing at a 90% chance now. So they're saying it's done deal. But it's the second part, is the outlook hawkish, dovish, or neutral? So it makes sense for it to be neutral, right? The reconciliation is effectively the statement versus market pricing for each month going forward. And what we've got, terminal priced at 3.02 at the moment. So, you've got to look at the steps that need to get to that point. But yeah, there doesn't seem to be a huge amount of drive or, what's the word? It doesn't seem to be the right thing to do effectively. If we've got payrolls coming out shortly after the Fed meeting and CPI as well, and if CPI core CPI was to drop a little bit and we were to see, a weak payrolls number, then, they've been shooting themselves in the foot, not keeping the door open and seeing market, financial conditions tighten on the back of that. So, I just think it's going to be, it makes sense for them to be purposely vague, I think would be the way I'd say this, to the point where it's like, a balanced statement would be good, but it really depends on how it reconciles to that market pricing. But they need to keep the door open for further cuts, given that we've got this payrolls data coming out shortly after, or some days after the Fed meeting. So you could be right. It could be, the market's expecting a hawkish cut, so you could see, the dollar sell off on that situation there. We'll have to see. So it's an interesting one. I mean, for a lot of people, they might just say it's too hard. Let's close out positions and wait for wait till we actually got the information and then reconvene with positioning after that point. But let's go into the event risk, because the Fed meeting is obviously really important. But there's plenty of other things. We talked about the Fed meeting. We talked about the payrolls after, going in, 16th or so, and then the CPI data after that point as well. But we've also got a Bank of Japan meeting, and we've seen JGB yields moving very, very sharply higher. There's been a very, very strong trend coming forward now. The market is certainly of the belief that we are going to see a rate hike from the Bank of Japan. That's now the probability coming through after we saw Governor Ueda's speech earlier in the week. But the only thing that's really kept these JGB yields from continuing to push up is that we saw a pretty strong 10-year JGB auction. So the demand was there, and that gave some relief that buyers are sensitive to prices at this level. I think today we've actually got a 30-year JGB auction, so we'll have to see how that goes. But the Bank of Japan, we've already seen a market that de-risked. When JGB yields moved higher, and people were sellers and there wasn't many buyers in the market, the market has shown, broad asset markets have shown their sensitivity to the sell-off that's happening in the long end of the curve. And it's not just the Bank of Japan. Remember, under the new PM's fiscal expansion plans, you've got more supply coming through. The government are going to have to fund themselves, and that increases supply just as lifted term premium. You've got a Bank of England meeting. They'll cut rates in that situation. You've got the Supreme Court's potential announcements on Trump's use of IEEPA tariffs. Potentially, we still could get the Fed chair coming through. So there's a lot of landmines for us to work through in December, right?
There still are. I mean, we have the RBA, we have the Swiss National Bank. I was just looking at all the other central banks that are still coming through. And you're right. And when you talk about JGB yields, it's not. This is a global phenomenon. I mean, you look at like the 10-year yields. I mean, they pulled back today, but yesterday we had yields. I mean, I guess it would be 2 days ago for you guys. We had yields rallying across the globe. So you're right. There are a lot of central banks that we need to be really focused on. And landmines. I think that's a good way to put it. And you're also right. The Fed, they have to leave and going back to the previous commentary, they have to leave the door open next week because they do get CPI. They do get, the jobs report. When's the jobs report again? On the 16th?
16th, I can't, 15th. I can't. Some saying 15th or 16th. I've written it down, but didn't bring it in.
Yeah, I'm going to look specifically. Oh, it is actually the 16th. Yeah, it's going to be the 16th, which, again, it's not your typical Friday event. It's going to be a Wednesday event. So lots of things that we have to work through. And on top of it, Chris, liquidity is going to be pretty poor on top of it all. All right.
Ooh.
I know.
Talk to me. Hit me up.
All right. So what's that?
Hit me up. Next one.
Okay. All right. Crypto is the bottom end. We've been talking about crypto a lot here on the trade-off over the last couple of weeks, signaling how it's really been leading risk assets lower. And we found what seems to be a near-term low in Bitcoin. Bitcoin found some buyers as we approached like 85,000. We're back above, we're at 93,600 at the time of recording right now. And we're getting close to 95,000. 95,000 is where I'm 95 to 98,000, I think is good resistance for Bitcoin. But if we can scale those levels, hey, we might be trading back above 100,000 by the end of the year. But the question is this low the low, or is it still just underperforming risk assets? And my answer, and then I'm obviously wanting to see what your answer is I believe this is a rally to be sold in crypto. The response, yes, we are getting a recovery. Yes, Ethereum's back above 3,000. That's great. But from the sell-off that we've seen, and where you look at risk assets, as you were pointing out, other indices, even other indices rather than the US, near all-time highs, we are still very, very far off of all-time highs in Bitcoin and Ethereum. And obviously, if you look at some of these altcoins, they still are just dragging. So that suggests to me that this is not a rally to be bought, but more of a rally to look for levels to take some profit, maybe to look for a reversal lower. What are your thoughts on crypto as it is, and are we going to go lower from here?
I think I definitely sit in your camp that it's a decent rallies there to be sold. I just don't feel the confidence is in there right now. The big hitters are they're hurt. They're still hurting from 10th of October and the flash crash, I think. We just haven't got that confidence, the conviction to chase a rally and keep pushing price higher. The FOMO, I think, is just not going to kick in anytime soon. If you look at what we've been seeing, I think one of the big talking points has been this, the Peter Schiff versus Michael Saylor debate. I think Michael Saylor's probably got the upper hand in the short term, given that Peter Schiff was saying that Michael Saylor was selling some of his 650,000 bitcoins, which he wasn't, and I don't think he will not want to do in that situation. But I think strategy had become a key player in this, a litmus test, and I think that they could effectively drive the Bitcoin price going forward. And even though they've only got 3% of the Bitcoins outstanding, I think the positive reading I'm seeing for strategy is that they've got $1.44 billion in a reserve fund. So they'll be able to meet their debt obligations. They've got about 6 different preferred share tranches, and they've got 5 or so what they called convertible notes, which pay semi-annual coupons. So they've got to service that debt on a semi-annual basis or a quarterly basis, depending on preferred shares. They'll be able to cover that interest expense for 21 months. But what happens after that point, as we go into that point, if their market cap and their what we call the TEV ratio, which is their total enterprise value, was to trade at a discount to the holdings of its Bitcoin, the NAV, then I think as we get into late next year, if that market dynamic, they're not going to be able to issue more shares. So effectively, that will be the point where the market will say they may have to sell some of their Bitcoin. We're a long way from that point at the moment, so that's causing some relief in the crypto scene. But I think it will be, if we get to that point late next year and we get close towards that 21 month, they'll be able to make that payment. But what happens after that? If the market dynamics are not suitable, there will be real stress on the common equity, and I think that could have some big implications for the crypto scene as well.
I just want to say hat tip to you, Chris. You put together a nice short video that talks about MicroStrategy. If you guys haven't seen it, make sure you're following Pepperstone's channel. Make sure you're subscribed to this channel so you can go watch that short that you just put out. When did you put that out? Yesterday? Today?
Yeah, yesterday. Yeah. I mean, it's quite balanced. I mean, really everyone was saying, this MicroStrategy is going to cause systemic issues for the crypto scene, and it might do, but it's not going to happen anytime soon. So that's why we're seeing a bit of relief in that. It's obviously a massively leveraged play, but you've just got to cut through the noise and look at the dynamics that play. I mean, I think it's just such an interesting business model. They they buy Bitcoin. Price goes up as long as the Bitcoin price is going up, and their market cap is trading or has been trading at a premium to net asset value, and it's sufficiently. The common equity investors will buy those shares at market, which will drip fed into the market over time, and essentially, Michael Saylor and the crypto and the strategy team get free Bitcoin because what happens is that let's say the market cap to NAV is trading at a ratio of 1.3. Buy those Bitcoin, that falls back down to asset level. They get free Bitcoin essentially, and then the price goes up. So it's an interesting business model how they've been going, but obviously markets may not be so kind next year, and that may force some liquidations. We'll have to see. But anyway, let's go to that's a setup and see what happens with the charts. Well, I'm going to go for Nat Gas because it is ripping. It is a momentum juggernaut. You do get this from Nat Gas from time to time. It is the bad boy of markets, and it has burnt a lot of people. It can, excuse the pun, when it goes on a tear, it can go on a tear. Now, what have we got? Fundamentally, we have record exports of Nat Gas from the US. We've got very, very low inventories coming through, and at that time, we then see weather patterns. The weather forecast is saying that they're in for parts of America are in for a very, very cold winter ahead. What happens? Nat Gas goes ripping. The CTAs jump on board, perpetuate the move higher. It becomes a momentum shift, and it has been ripping. You can just see that parabolic move playing through. The question we're asking now is obviously with the current Nat Gas price, pricing in quite a lot of that information, and obviously you've seen a bit of a shift coming through in the futures curve. Has there more upside in this at the moment? But the close we've just seen there today is up 4%. Pretty close to the highs. Doesn't suggest that people are concerned about holding positions, and this is looking fragile despite that being momentum. So for me, stay long, tighten those stops up, follow the market, and I don't know where this could go, but it doesn't give me any hallmarks at this point that we're in for a massive reversal. So you're happy to stay long and just tighten those stops up.
All right. Well, that is a serious Momo trade that you brought up there. Yeah. And it's funny. I was this close to talking about it earlier today as well, because it's like, what an explosive move. All right.
Sorry, just to jump in, compare it to European natural gas prices, which are in actually a crazy downtrend. People are obviously looking at the Russia-Ukraine developments brokered by Trump and saying, well, Russia could be coming back into the energy markets at some stage. And that's obviously the opposite situation there. So European nat gas prices have been
interesting, very interesting. All right, well, Chris, I'm gonna pull up sterling, pound US dollar, and the reason why I'm bringing up this chart is, hey man, we're past the budget, and guess what? Everybody in the UK is still alive and they're still standing. And the fact of the matter is we are seeing a squeeze. Now, I actually think this is more of a dollar move. I've had a couple of conversations with some of my teammates, my colleagues over at Forex Analytics, talking to them about this move. I do think it is a little bit of both, though. I mean, you got some dollar selling that's coming through the market, but you also have a nice bull flag pattern in sterling. So we just broke the 38% retracement. That was at 133.13. We are now back above the 50-day and the 200 DMA. And by the way, for those of you that look at technical analysis and you look at the daily charts and the 50 and the 200, and you're like, that was a death cross. Well, guess what? If you sold it because you saw the death cross last week, you're covering today for a loss as it breaks back above those moving averages. And it looks like to me we are squeezing to at least 134. Now, obviously, a failure back below the 50 DMA would be really bearish. That's why I think it is a setup. I think it's a setup, that's got to finish up its bullish flag pattern to 134, which isn't very far away for sterling. We might be doing it in the next 24 hours, but I still think it is a nice show of force for the bulls.
Cheeky 50 pips in that one. Might be a nice one. Anyway, I'm going to go to silver because, again, I'm just following with my very mature but very strong movers here. Now, it's been, obviously, everyone knows it's been an incredible year for silver. I think we're 102% year to date so far. There are different dynamics relative to gold. So a lot of the reasons people have bought gold for investment purposes, central bank, flown through to the silver market. But what we've also seen is inventories in China Shanghai inventories have been coming down. I think 10-year lows. You've got inventories in the US, copper stocks coming down to the lowest level since March. So there's a tight supply dynamic playing through. Demand has been pretty strong. But what you're seeing is this really strong move that's been taking place on low inventories, low stocks, good demand, but just this really big deficit taking place. And I think that's why you've seen the big outperformance from silver. It's not just because of the relative liquidity in silver versus gold, which pushes the price up more significantly. But there's a lot of fundamental dynamics playing through. So what do I like? We like the breakout. If you use a measured move between that range, well, you've we've still got some decent upside playing through. And that price action that we've been seeing on the higher time frame, 4-hour, daily, weekly, it's shown that the market wanted to roll over, bang, the buyers stepped in at the moment. So there's great demand on any intraday pullbacks. It does still suggest to me that there's still some upside left in this bad boy.
All right. Well, I'm not sure if there is any upside. Take a look at crude. So crude oil now, I try to be an optimist when I look at the crude oil chart, but you can see it's tightening near the lows in a triangle. It's capped by the 50 DMA, but the fact of the matter is, if we can get above the 50 DMA, which is basically 60, you can just say if we get above $60, we're going to get a recovery. I think we'll get a recovery to the 200 DMA, which is just sub 64. But the fact is that we're consolidating near these lows. And Chris, we've talked a lot about this. I haven't shown this chart obviously in a couple of months. That's when I had the bear flag pattern drawn. This is still same drawing from the last time we talked about it, which it did finally complete. But the fact is, we've talked about how important that $55 level is. And I'm fearful that if we start to see something that suggests that crude oil goes down, whatever it is, whether it's geopolitical or maybe it's global economic data that comes out. If we break through that triangle support, then we are probably going to make a run at that $55 level. Yeah. It's a setup. It's tight. I love it when it's tight like this, because when it's tight, it's getting ready for a breakout.
Yeah, which way it goes, no one knows. I mean, there's a lot of bad news, but everyone's focused on this glut that's going to be taking place next year, and that means OPEC are not going to continue to, they'll be very cognizant of that pricing going forward. But also the other factor is as well, the break-even cost for a lot of these US shale gas guys is around $47 on. So the lower that goes, we've already seen a response this year with oil rigs being taken off. We're at the lowest levels for a while. Inventories have been rising, so. Yeah, we'll see how that dynamic plays. I mean, obviously, Trump's loving this right now because he's got it to the sweet spot. But, an interesting setup. The price will reveal itself, and maybe that sets off a new trend, which we can jump on board. Anyway, let's go to play of the day. Well, I'm going to stay with my my commodity plays because that's what we are seeing, some good moves in the dollar for the first time in a while, but we're also seeing some really, really strong moves on a broad base in commodity markets. Blake just showed you the chart of copper, crude, silver, Nat Gas. They're all moving. There's some moves being made. This is where the flows are taking place. But look at copper. LME copper is now trading at all-time highs. The CME copper price, the high-grade copper here now, has broken out of the ceiling. I think this goes high. What we're doing is, again, this comes down to inventories. You are seeing people moving copper out of the LME LME warehouses, and again putting them back into CME into the CME storage. That's been rising, but so many people now are playing the arb between the two. They're going long CME copper, short LME copper, and trying to create that arb going forward. And we're now seeing that the high grade US CME copper price outperforming, and the arb is working in favour of that. But so you've got that flows taking place. People are buying that CME copper. which is what you're seeing there. But the breakout is really, really powerful as well. The fundamentals are very supportive. You've got disruptions taking place on around supply, which is curbing supply. You've got concerns around Trump's refined tariff tax and what that could mean going forward. And you've got momentum. You've got this trifecta of bullish factors taking place. Prices responding. I think this still goes higher.
All right. Well, Chris, that is a heck of a breakout. And I love it. Well, you got to break out. I got to break down. Ooh. Let's take a look at the dollar. Now, you were just talking about it a little bit earlier. We were, looking at it, I guess it was two weeks ago, or is it last week? 2 weeks ago, it was trading above the 200 DMA. And we were thinking, man, this thing looks like it could break out, and it couldn't. And you notice, if you look left, guys, that is the lows from September of 2024. We just really stalled at that resistance and we rolled back over. We're back below the 50 DMA. Now you got a double top in play. And so the double top actually points back down towards 97.60 roughly. And that means there looks like that we could see some further downside. Now, if you take into account, is Hassett weighing on the dollar, is the idea that we're going to have this FOMC chair, ready to slash rates as soon as he comes in office, or he takes the chair, sure. Are we at the end of the year and stock markets are near their all-time highs, at least in the S&P and a lot of other indices? Sure. So should there be some dollar selling going into year end? Probably. As stocks continue to rally, if there's nothing derailing it, the dollar's probably going to stay under pressure. Now, one thing I will state, though, we have everybody has in their mind that Kevin Hassett is the man. If there's any inkling or any idea that he is not going to be the man for the Fed chair, you're going to probably see the dollar reverse on that. So that's the one thing to be watching. But keep your head on a swivel. I'm short some dollars, and it looks like it's going to bleed, into the next couple of weeks.
Yeah. Well, thank you, Blake. Thank you, everyone, at home for watching this far. Smash the like button, hit the subscribe button. Markets are there. They're moving around. This is not time to be taking holiday. Don't sacrifice those profits. Anyway, stay safe. We'll see you back next week for more of the trade-off.